Good morning, afternoon, or evening, ladies and gentlemen, and welcome to this week's lecture on one of the most significant events in U.S. economic history, the stock market crash of 1929. This catastrophic event sent shockwaves throughout the world, leading to severe economic repercussions and ushering in the era of the Great Depression. In this lecture, we'll explore the events that preceded the crash, the regulatory environment, the state of the economy, and the interconnectedness between the crash and the Great Depression. The Roaring 1920s were a period of unprecedented economic growth and exuberance in the United States. Following the end of World War I, the nation experienced a surge in industrial production, technological advancements, and a booming stock market. However, this prosperity was not without its flaws, as underlying issues began to reveal themselves. The stock market became a symbol of wealth and opportunity during the 20s. Investors flocked to Wall Street, fueling a speculative frenzy. The prevailing belief was that the stock prices would continue to rise indefinitely, leading to an overvaluation of stocks. The practice of speculation was rampant, as individuals and corporations sought to make quick profits by buying and selling stocks based on anticipated price movements. This speculative mindset led to a detachment from the fundamentals of companies and their earnings, as investors became more focused on short-term gains rather than long-term value. One significant factor that contributed to the speculative fervor was the widespread availability of margin trading. Margin trading allowed investors to purchase stocks with only a fraction of their value, borrowing the rest from brokers. This practice amplified both potential gains and losses, increasing the fragility of the market. While margin trading provided opportunities for individuals to enter the stock market with limited capital, it also exposed them to significant risks. During this period, there was a surge in the creation of investment trusts and holding companies. These entities pulled funds from investors to invest in a portfolio of stocks or businesses. However, the lack of transparency and oversight surrounding these trusts allowed for potential abuses and fraudulent practices. The prevailing attitude at the time, often captured by the phrase easy money, contributed to the speculative fervor. Many Americans believed that anyone could become wealthy by participating in the stock market, and the allure of quick profits became irresistible. Famous financier Bernard Baruch captured the spirit of the era when he said, "Millions of dollars are being made and lost in the frenzy of speculation. Wall Street seems to be sitting on a volcano." The soaring stock prices created a sense of euphoria among investors. This exuberance was further fueled by the media, which regularly reported stories of individuals who had amassed enormous wealth by investing in stocks. Magazines, newspapers, and even ticker tape machines disseminated stock quotes and market news, capturing the attention of the general public and encouraging their participation in the market. However, beneath the surface of this apparent prosperity, there were warning signs of an overheated market. Some prominent economists and financial experts raised concerns about the unsustainable nature of the speculative bubble and the potential consequences of a market correction. However, their voices were often drowned out by the prevailing optimism and the perception that the stock market could only move in one direction, up. As the speculative frenzy grew, investors began to disregard traditional valuation metrics such as price-to-earnings ratios. Instead, they focused on stock prices as a measure of success, leading to an overvaluation of companies. This disconnect between stock prices and underlying economic realities laid the groundwork for the eventual crash. The speculative boom reached its peak in September 1929, just a month before the crash. Stock prices had soared to unprecedented heights, driven by the influx of new investors and the availability of easy credit. However, this exuberance was not sustainable, and a correction in the market was imminent. Now I'm going to talk about overproduction and agricultural crisis. The industrial and agricultural sectors experienced significant imbalances during the 1920s. Technological advancements led to increased productivity and overproduction, particularly in the manufacturing and farming sectors. Consequently, the oversupply of goods pushed prices down, diminishing profits and triggering layoffs. While overproduction was a domestic issue, it also had international ramifications. American manufacturers, driven by their increased productivity, sought new markets to absorb their surplus production. This led to a surge in exports as American goods flooded international markets. However, this influx of American products created trade imbalances as other nations struggled to compete and maintain export levels. The United States, as a major creditor nation following World War I, lent substantial amounts of money to war-ravaged European countries. These loans were critical for Europe's post-war reconstruction, but ultimately strained the global economic system. As European economies struggled to repay their debts, the flow of capital between nations became disrupted, leading to trade imbalances and declining international trade. Excuse me. To service their debt obligations, European countries relied on exporting goods to the United States. However, as American industries overproduced and domestic consumption slowed down, the demand for imported goods declined. This posed a significant problem for European nations, as their economies heavily relied on exports to the U.S. to generate revenue. In an effort to protect domestic industries and jobs, the U.S. government passed protectionist measures such as the Fordney-McCumber Tariff Act of 1922 and the Smoot-Hawley Tariff Act of 1930. These acts imposed high tariffs on imported goods, making it even more challenging for foreign countries to access the American market. These protectionist policies further exacerbated the trade imbalances and strained international economic relations. As trade declined and debt repayment became increasingly difficult, European nations faced economic hardships. This weakened their ability to purchase American goods, further contributing to the problem of overproduction and excess supply in the U.S. The interdependence of economies and the failure to address international debt and trade imbalances added to the fragility of the global economic system, setting the stage for the eventual crash. In this interconnected global economic environment, the stock market crash of 1929 had far-reaching consequences. The decline in stock prices and the subsequent economic contraction in the United States had a ripple effect, leading to reduced demand for goods and services worldwide. The economic crisis spread like wildfire, affecting economies across continents and exacerbating the effects of the Great Depression on a global scale. And now we're going to look at regulation, or the lack thereof. The laissez-faire economic policies of the 1920s fostered an environment of minimal government intervention. Regulatory oversight of financial markets and banking activities was lacking, allowing speculative practices to go unchecked. This absence of effective regulation enabled the growth of a speculative bubble in the stock market. One aspect of the regulatory environment that contributed to the lack of oversight was the limited disclosure requirements for publicly traded companies. Companies weren't required to provide detailed financial information, leaving investors in the dark about the true value and financial health of the businesses in which they were investing. Furthermore, there were no regulations in place to control or monitor margin trading, which fueled excessive speculation. Margin requirements, the amount of money investors were required to put down when purchasing stocks on margin, were low and largely unregulated. This allowed investors to take on high levels of debt to finance their stock purchases, leading to increased market volatility and heightened systemic risk. In the absence of effective regulations, fraudulent practices and insider trading also became pervasive. Some unscrupulous market participants manipulated stock prices or disseminated false information to inflate stock values, taking advantage of the lack of oversight and investor naivety. The Federal Reserve, the central banking system of the United States, played a significant role in exacerbating the conditions that led to the crash. In the years preceding the crash, the Federal Reserve pursued a policy of easy credit, keeping interest rates low and encouraging excessive lending and speculation. Following World War I, the Federal Reserve sought to support economic growth and stabilize the financial system. To achieve this, it implemented a loose monetary policy characterized by low interest rates and an expansionary approach to credit availability. This policy encouraged borrowing and fueled the speculative activities in the stock market. However, as the speculative bubble continued to inflate, some voices within the Federal Reserve expressed concerns about the excessive credit expansion and the risks it posed to financial stability. They advocated for tightening monetary policy by raising interest rates to curb speculation and cool down the overheated market. Unfortunately, the Federal Reserve didn't act decisively. It was hesitant to raise interest rates due to fears of stifling economic growth and concerns about potential adverse efforts on other sectors of the economy, such as agriculture and manufacturing. As a result, the Federal Reserve's actions were insufficient to temper the speculative frenzy in the stock market. When signs of economic strain began to emerge, the Federal Reserve finally decided to act. In 1928, it began a series of interest rate hikes in an attempt to rein in the excesses of the market. However, these actions were too little, too late. The interest rate increases further tightened credit conditions and intensified the downward spiral of the economy, ultimately exacerbating the severity of the crash. The Federal Reserve's role in contributing to the crash was not limited to its monetary policy decisions. The central bank also failed to exercise effective oversight and regulation of the banking system. Banks, particularly those in speculative activities, were not subjected to stringent regulatory controls. This lack of oversight allowed banks to engage in risky practices, such as making loans to investors for speculative stock market investments, contributing to the vulnerability of the financial system. Black Thursday, which occurred on October 24, 1929, marked the beginning of the stock market crash. On that day, a sense of panic gripped Wall Street as investors scrambled to sell their shares. The market experienced a sharp decline in stock prices, triggering a wave of selling that overwhelmed the trading floor. The volume of trading reached unprecedented levels as investors sought to liquidate their holdings. However, the sheer number of sell orders exceeded the capacity of the stock exchange to handle them efficiently. As a result, the ticker tape, the mechanism used to relay stock prices and trading information, fell behind, creating confusion and exacerbating the panic. As the day progressed, leading stocks plummeted, wiping out significant portions of investors' wealth. Blue chip stocks, which were previously considered stable and reliable investments, saw their prices collapse. Prominent companies such as U.S. Steel, General Electric, and RCA suffered heavy losses. News of the stock market turmoil spread rapidly, contributing to the growing panic. The public, fueled by fear and uncertainty, rushed to their brokerage firms and banks to sell their stocks or withdraw their savings. However, the combination of the overwhelming selling pressure and the inability of the financial system to accommodate the massive withdrawals intensified the crisis. 5 days after Black Thursday, the stock market experienced its most devastating day, Black Tuesday. On October 29, 1929, stock prices collapsed, resulting in a cataclysmic loss of value. The decline was so severe that the market lost an estimated $14 billion in value, an astronomical sum at the time. Panic selling reached unprecedented levels as investors desperately sought to exit the market. Stock prices plummeted, with some companies losing as much as 90% of their value compared to their peak levels. The ticker tape once again struggled to keep up with the flood of sell orders, causing confusion and chaos on the trading floor. The crash on Black Tuesday had a profound impact on both individual investors and the broader economy. Many investors saw their life savings wiped out in a matter of hours. Business leaders who had previously enjoyed great wealth and success now faced financial ruin. The crash shattered the illusion of never-ending prosperity and exposed the inherent risks of speculative investments. The stock market crash of 1929 acted as a catalyst for the Great Depression, an unprecedented economic downturn that lasted throughout the 1930s. The crash revealed and intensified the structural weaknesses and imbalances that had been building up within the economy. The economic devastation caused by the crash and subsequent Great Depression necessitated government intervention. President Franklin Roosevelt's administration implemented a series of reforms and programs collectively known as the New Deal. These initiatives aimed to stabilize the economy, create jobs, and provide relief to the American people. Ultimately, it could be argued that World War II was the event that brought our nation out of the Great Depression that had begun by the 1929 stock market crash. Ladies and gentlemen, I hope you learned something, I hope you enjoyed it, and I hope you have a good night. Thank you. Bye.